Hi everyone, please take note of the following disclaimer. Please note that this video is for informational, educational, and entertainment purposes. It does not constitute financial advice. We are not registered financial advisors. Hey everyone, welcome back to the channel. In today's video, we're gonna do a little review of one of my personal favorite income-oriented covered call ETFs on the Canadian stock market, HYLD, the beloved HYLD, which, in case you're newer to the channel, newer to this style of investing, or newer to this fund, has gone through not one, not two, but actually three transformations. So we are currently on HYLD 3.0 right now. So what we're going to do in this video is go through a brief history of HYLD. I actually looked at past videos to see what HYLD had during HYLD 1.0 when it came out in early 2022. HYLD 2.0, where it got a massive upgrade in early 2024, and the last couple of months we've had HYLD 3.0. So we'll go through the history. We'll look at HYLD 3.0, what HYLD is now, what it has, and then of course we're gonna look at HYLD's performance, right? How is it doing versus the S&P 500 versus some of its competition, etc., etc. So let's get started with the history of HYLD. So I actually had to go back to some of my old HYLD video guys to figure out or try to find the holdings of HYLD 1.0 and 2.0. And basically here it is. This is HYLD 1.0. Remember this? This is taking me down through memory lane for sure. So it's a little bit fuzzy because it's basically a screenshot from my YouTube video, but I think it's, you have it pretty clear here of the holding. So remember that back in the day, guys, Hamilton ETFs did not have their own covered call ETFs. They didn't have a team, a covered call, portfolio managers. Nick Picard was not there. He was still at Global X. So what they did, and this is the same thing with H did, they basically combined external covered call ETFs, packaged them together to do an approximate breakdown or approximate similar sector allocation to the S&P 500, and added 25% leverage on top of the structure. So you have HHL, HBF, which are two of the top covered call ETFs from Harvest that take care of healthcare, your healthcare stocks, and there's the brands. They also had the Horizon Enhanced Income Gold Producer ETF, HEP, which is now GLCC. So they had some gold in there as well. They had TXF. This is technology. Remember TXF? So the technology covered call ETF from CI that does at the money calls on 25% of the portfolio, which is still around. These ETFs are still around. All of them are actually still around. HEP is now GLCC. And then we have what I think didn't work out so well and really dragged HYLD down at the beginning because of the, what I like to call the steam engine of covered call strategies, XYLD, RYLD, and QYLD from Global X. These were on the American stock market. So the NASDAQ 100, Russell 2000, and the S&P 500 index. The problem that I have with these ETFs now that I have covered call knowledge and that I know what I'm talking about is the covered call strategy is not good for total returns, right? So XYLD, RYLD, QYLD does at the money calls on the entire portfolio. So essentially you're giving up the entire portfolio. And there was I wouldn't say crash, but the S&P 500 or US stock market went down right after HYLD was launched. HYLD was launched, like it says here, in February 4th, 2022. So because the QYLD and RYLD and XYLD were such a big portion of the portfolio, and when the market started recovering, these ETFs don't recover pretty much because of the at-the-money calls. It really dragged HYLD down. At one point, they also had to reduce the distribution. You remember that. So this is HYLD 1.0. So moving on to HYLD 2.0, which happened in early 2024. This is when, and this happened on HDIV as well. I'm going to make another video on HDIV separately. But in 2024, early 2024, this is when HYLD basically brought everything in-house. They kicked out all the third-party ETFs, which is a huge benefit because of huge management fee reductions, right? Because you had to pay the management in HYLD 1.0, you had to pay the management fee, the Hamilton ETFs, and then Hamilton ETFs had to pay the management fees for all the ETFs inside. But in HYLD 2.0, which happened in early 2024, that's when Hamilton hired their own team. Nick Picard came, and like you see here, it's all Hamilton cover call ETFs, and that's how they were able to bring down the management fees substantially, because there's no double management fee. So essentially, it's like the management fee was cut in half, pretty much, right? So this is HYLD 2.0. So you see the main core positions are their yield maximizer ETFs, SMAX and QMAX. SMAX is kind of like a concentrated S&P 500, top 25 stocks. The S&P 500, QMAX, very technology focused. And then they have some LMAX and FMAX, which focus on healthcare, financials, a bit of gold, a bit of energy, and even a little bit in a bond ETF, HBND. But this is HYLD 2.0. So typically when I do the total return comparisons, I always start in January. It should be February, but I always start the start date January 2024 for this reason. So other YouTubers, of course, you could always do they do the total return since inception. That's fine, that's fair, but it's very important to understand, if you don't know the history of HYLD. HYLD really became good HYLD, in my opinion, here in early 2024. This is when it really became 100% Hamilton ETFs, HYLD 2.0, where everything, all the ETFs inside are Hamilton ETFs. So what about now, everyone? What about HYLD 3.0? Well, guess what? HYLD 3.0 came out a few months ago, essentially because of the new Daymax ETFs that Hamilton have launched about 5-6 months ago. So got plenty of videos on those, but just in summary, in case you didn't know, they came out with the first 0DT covered call ETFs in Canada. So you have SDAY, which was not included in HYLD, which makes complete sense because HYLD focuses on the US, right? It's called the US cover call ETF, enhanced cover call ETF for a reason. But they also came out with SDAY and QDAY, which focus in the US. So it's no surprise that those two, SDAY and QDAY, are now in HYLD. So now you have HYLD 3.0, everyone. You're looking at it right now. Still SMAX and QMAX are the top positions, just like in HYLD 2.0. You have FMAX, of course, for some financials, because there are financials is actually in the top 3 sectors of the S&P 500, right? It's technology, healthcare, and financials. Those are the top 3 sectors of the S&P 500. Remember what HYLD is? Maybe I should have started with this. HYLD is basically a diversified blue chip US equity exposure. Here's the key. It's a higher yielding alternative to the S&P 500 with similar volatility. I repeat, with similar volatility. Very, very important. Why do they say similar volatility and not less volatility, right? Cover call ETFs typically always have less volatility. When you're doing cover calls on something, you're lowering your volatility. But because HYLD has 25% leverage, this balances out the volatility reduction of the cover calls, right? Leverage increases volatility, cover calls lowers it. So these two kind of balance out. So that's why they say similar volatility to just holding the S&P 500. And again, it's not exactly the S&P 500. It's an overall sector mix broadly similar to the S&P 500. Another thing to remember is that there's 2 versions. There's HYLD, which is Canadian currency hedge. This is why we're in the total return. We're always going to compare it to VSP, because VSP is the Vanguard S&P 500 hedge, the Canadian dollar. But they also have HYLD.U, which is in USD currency, but it's not hedged the Canadian dollar. Still listed on the still listed on the Canadian stock market, but you just buy and sell it in USD currency. This is unhedged, like it says here. So HYLD, for the best total return comparison, in my opinion, to see how it's doing versus the S&P 500, should be compared to VSP, and HYLD.U should be compared to VFV, the non-leveraged version, and we're going to do that in a second. So that's just an overview of what HYLD is. Remember, again, a higher yielding alternative to the S&P 500 with similar volatility. That is literally the best way you could describe what HYLD is. And if you look at the sector breakdown, guys, this is as of June 2025. It's very similar to the S&P 500. S&P 500 is a third, 35% technology. The other two big sectors in the S&P is the financials and healthcare. You see that here. So this is HYLD 3.0, everyone. So you see SMAX, QMAX are still the two top biggest positions. FMAX is still there as well, but they added SDAY and they added QDAY as well. So that is the first change in HYLD 3.0. Another change is that they took out the bonds. So remember, even in HYLD 2.0, there was a little tiny bit in HBND. They actually removed that completely. There's no more bonds. So now this is pretty much 100% equity, which I love. Thank you so much, Hamilton ETFs. Get those bonds out of there. I'm so happy they did that. It was a small position, but they did that as well. So bonds are gone. A little bit of SDAY and QDAY are added. You have the percentages here. And another thing that changed, they added RMAX. RMAX is one of their latest yield maximizer ETFs. It wasn't in HYLD 2.0, so a little bit of real estate. And keep in mind, there is a little bit of gold here, 5.3% of in AMAX, which is gold producers. So, that's probably going to cover the materials here. So there is a little bit of gold. I think more gold exposure to the regular S&P 5, to a regular S&P 500 index. But there you have it, everyone. And remember, these percentages, there's 25% leverage. So if you add it all up, it's not going to be 125% exactly. But that's because SDAY and QDAY are themselves leveraged 25%. We're going to take a look at them in a second. So that's why I'm assuming that they don't want the whole leverage amount of HYLD, or the amalgam leverage, I guess if you could say that. I think you guys know what I'm trying to say, to exceed 25%. That's why if you add it all up, it's going to be less than 125 because, again, QDAY and SDAY are already leveraged 25%. So, in terms of distributions now, we know the history, right? If you've been with me for a long time, you obviously know we've been tracking this. HYLD started at these distributions here, about 14 cents, and then they had to drop the distributions in early 2023 here because of the QYLD, RYLD, and XYLD not doing that well, and they at one point they had HYLD became 1.0 became 1.5. They added JEPI in there and JEPQ as well. So I don't have the screenshot for that, but they've made some progress. So it did reduce to 12 cents, but then eventually it started going back up and increasing once they started bringing everything in house. You see 13.8, 14.3, and now 14.5, 14.7, and now 15.3. I'm assuming, my assumption is the latest jump was because of the addition of SDAY and QDAY, right? So we're at 15.3 now, which is higher than it first started with. So that is the journey for the distributions, everyone. Now, what is SDAY and QDAY? We should look at it real quick. And I have a whole video with Q&A with Nick Picard. I'm actually speaking to him again this week to discuss the QDAYs as well, the QDAY and SDAY and CDAY as well. But SDAY is essentially basically a very, very unique idea. It's the first zero DT style cover call ETF in Canada, but there's kind of a twist. So it's very cool what they did. 100% of SDAY holds the Hamilton Champions US Dividend Index ETF, which has no cover calls whatsoever, guys. And the rest of the portfolio, or you could say the leverage portion of the portfolio, there is 25% leverage here. That's why the total here is about 125%. But the rest, or the leverage portion of the portfolio, simply holds VOO, the S&P 500. And this is where they're writing the zero DTE covered calls on. So you could essentially say that 80% of this fund has no covered calls. It's pure growth coming from this ETF here, which is this ETF right here. And what does this ETF hold? Again, this is a dividend ETF. It's not a covered call ETF. It holds some of the best blue chip US dividend aristocrat stocks in the US. 35 companies. You'll recognize a lot of the names: Caterpillar, Lilly, P&G, Coca-Cola, Walmart, McDonald's, really the more boring companies, dividend boring stocks, right? So not as much technology. You could go through the full list, but it's really going to be those boring blue chip dividend stocks. That's what really SDAY is. And to generate that high approximate 18% yield, they're doing at the money cover calls on VOO, right? So to me, this is kind of like dividend investing meets cover call investing. It's really, really cool and unique. QDAY, on the other hand, and you got your sector diversification here. QDAY is more technology focused with the same concept, except they're holding the XLK ETF instead of the SMVP ETF. And then with the leverage portion, where they're doing their covered calls on is QQQM instead of VOO, so the NASDAQ 100. So again, 80% of this portfolio has no covered calls on it, which is this portion here, XLK. They're only doing those 0 DTE cover calls on the QQQM, on the NASDAQ 100. So what is XLK? It's a index-based pure technology ETF, market cap weighted. So think of it like a concentrated NASDAQ, if you will. If you look at the top holding, guys, it's basically NVIDIA, Apple, Microsoft. You got the top pure technology stocks here in this ETF, guys. So this is a pure play technology. Notice that things like Google will not be here. Things like Tesla will not be here. These are only companies that are considered pure technology. So that's what QDAY is. So in HYLD, now you should know what everything is. SDAY is here, QDAY is here, and we just looked at that. These are the newest additions to HYLD, making it HYLD 3.0. All right, so now let's do the fun part, right? Let's prove all the growth bros wrong, and I'm going to show you how a covered call ETF is actually doing really, really well in terms of growth, in terms of total return. So before we continue, I'd like to tell you about the Moomoo Canada, a DIY broker that always has some great welcome offers. For example, deposit $100, get $50 cash back. Deposit $5,000, get up to $300 cash back. 60 days of commission-free trades. They also offer 6% interest on your idle funds up to $10,000 balances. If you're transferring from another broker, you could get extra cash back, as you could see here. If you convert Canadian to US and vice versa, Moomoo is very, very competitive. Well, you can't get any more competitive than 0% fees versus other brokers that typically charge 1 to 1.5%. If you're doing options, Moomoo is also very, very competitive to other brokers as well. And there's many, many more features. One of the coolest ones is by far the AI chatbot. So Moomoo was one of the first brokers in Canada to introduce AI into their broker. We could ask it anything about certain stock and earnings and sentiment, etc., etc. There's also an auto buy feature as well, where you could schedule consistent buys for whatever ETF and on whatever day you want, which is very useful if you want to buy a little bit over time and make it all automated. And I strongly recommend to check out their desktop application. I'm always amazed on how fast and how cool their desktop app is. There's watch lists. You could check out what's going on in the market live. It's very, very quick. The transitions are flawless. There's screener tools. So I highly recommend it, everyone. You really have nothing to lose, right? Deposit that $100, get $50 cash back and play around with it. I'm pretty sure you'll enjoy it. And just for PII members, as a special added bonus, if you deposit $1,000, you will get an additional $30 Amazon gift card. So check it out, guys. The link is in the video description below. I'll even pin it at the top. Just make sure to get all these features. You actually use the affiliate link and you'll have to see the PII/Moomoo, as you could see here at the top left. What we're going to do is using the BMO ETF comparison tool, I'm going to compare it to what I think is HYLD's main competition. So I put HYLD in HYLD.U. Remember, HYLD.U is not hedged the Canadian dollar. HYLD is hedged. USCL is basically the Global X S&P 500 cover call ETF, also with cover calls, also with 25% leverage. Then you have the Evolve S&P 500 cover call ETF, which is the S&P 500 with cover calls, no 25% leverage. ESPX, it's hedged to the Canadian dollar, just like HYLD is, and ESPX.U, well, kind of the same thing, HYLD.U. So if you do the comparison, these comparisons make sense in my opinion. Since common inception, so that means that it's going to use the start date of the latest fund, which is July 5th, 2023. So we're using a start date that's even before HYLD 2.0. I just want you guys to remember that. I repeat, we're doing the comparison even before HYLD 2.0. And the total returns are incredible for HYLD. You see that HYLD.U and HYLD are beating everyone. So it's no surprise they're going to beat ESPX and ESPX.U, because HYLD and HYLD.U are, you could say, concentrated versions of the S&P 500, if you will, and they have the leverage. And then you even see versus USCL, they're beating USCL. So of course USCL is beating ESPX.U because it has that leverage, not by much, but a little bit. But you see how well HYLD and HYLD.U are performing versus its competition. But of course, the main thing we should always compare it to is HYLD versus VSP, right? The Vanguard S&P 500 hedge the Canadian dollar. And I know HYLD is not exactly the S&P 500, but we have to compare it to something. So if we do it since inception, since the beginning, since, you know, HYLD 1.0 when it wasn't that great. Sorry about that, guys. Was having some internet trouble. So if we do HYLD versus VSP since inception, you see that HYLD is lagging behind a little bit. This makes complete sense because we're doing it since HYLD 1.0 and HYLD 1.0 and even 1.5 was definitely not as great, right? HYLD really became good, or became what I feel is the real HYLD, when they kicked out all those external ETFs. They brought it all in-house. They reduced the management fee in early 2024. So if we actually change the date to January, well, actually we should do February, because that's when I think it was end of February. I can't remember exactly. But if you do February 1st, 2024 as the start date instead, you'll see a big difference. It's destroying VSP. This makes complete sense. And especially lately, you see that there's been a big gap forward lately. My hunch is that because a lot of the gains of the S&P 500 are coming from key stocks, like the technology stocks, NVIDIA, AMD, and because HYLD is a little bit of a concentrated version of the S&P 500, so there's more weight in those stocks, because those stocks are in SMAX, those stocks are in QMAX, those, you know, and with the addition of the QDAY and SDAY, I believe this is why HYLD is just absolutely taking off versus VSP. So HYLD, since HYLD 2.0, is officially beating the S&P 500 easily by a big margin. So it's doing its job. The performance has been extremely impressive, in my opinion, right? I mean, you can't argue with this. Numbers speak for themselves. I'm just curious, what if we just do VFV, although it should be HYLD.U that we compare to VFV. I'm just curious here. It's actually beating VFV, so regardless of the crappy currency hedging, which is obviously brought down, or why HYLD is underperforming HYLD.U, you see that it's keeping well in line, and it's slightly outperforming VFV even at this point. So HYLD, everyone, in terms of total returns, is doing absolutely phenomenal. Let me make sure I'm on the common date here. So I guess I wasn't on the common date, but common inception, but now I am. So let's revisit the performance again. So you see HYLD, HYLD.U still in the lead. You see that HYLD.U, which the best comparison is USCL, because USCL is not hedged the Canadian dollar, and ESPX.U, not hedged the Canadian dollar, it's outperforming. It's very, very good. And even HYLD, which is hedged the Canadian dollars, outperforming USCL. So it's doing really, really well, everyone. Let me just kick out here. Let me see here. Let me kick out. Let me leave. I'll take out these ones. Let me add VSP. So all three of these are hedged the Canadian dollar. And you see that it's not even close. HYLD is doing absolutely phenomenal since the common inception. So common inception, what are we using as a start date here is January 9, 2023. So even before HYLD 2.0, you see that it's doing really, really well here. I mean, the total returns really speak for themselves, outperforming the S&P 500. So there you have it, everyone. That is a summary of HYLD, our beloved HYLD. It's doing really, really well. A little bit of a history, a little bit of an update on HYLD 3.0. I hope you enjoyed the video. Give me a thumbs up, guys. I would really appreciate it. Make sure you like the video. And I mean, HYLD is... I really love the management team here, Hamilton ETFs. You know they're good friends of the channel, but I think they've done a phenomenal job with HYLD. If you would ask me how would I make it even better, HYLD 4.0, and I think this might come eventually, I would like to see SDAY and QDAY have bigger percentages in the portfolio. So I think maybe they just started to add it to see how HYLD reacts. But I would definitely maybe make SDAY. I would like to see SDAY more in the 10 to 12, maybe up to 15% range, and I would love to see QDAY in the 10 to 12, even 10 to 15 range, because I think QDAY and SDAY are really, really great ideas. They add diversification of strategy as well, especially QDAY. I think QMAX, it could easily reduce QMAX by 10% and just jack QDAY by 10%. That will actually also help the yield because QDAY has much higher yield than QMAX and SDAY has higher yield than QDAY. So I think that if they do that, they'll be able to bump up the distributions. Another thing I would really love to see is an HYLD.B, an unhedged Canadian dollar version. So I know we have HYLD.U, but if you want to stick to Canadian dollars, you don't want the hedging, I think another version, a .B maybe, or a dot whatever, unhedged, would be great as well. So let me know what you think. What do you think of HYLD 3.0? Do you agree with my assessment? Is there something I missed? Let me know in the comment section below. Take care, everyone. Stay safe, stay passive, stay honorable. See you next time.